If you found yourself with some extra money and are considering investing, but feel overwhelmed or confused about where to start, you're not alone. Investing can seem like a complex world, especially for beginners. That's why this guide is designed to break it all down for you in a simple, step-by-step manner. By the end of this video, you'll have a clear understanding of why you should invest, what to invest in, how much to invest, and even how to buy your first stock. Let's dive in. Part 1. Why you should invest? The primary reason to invest is to make your money work for you. Let's say you have an extra $1,000. What are your options? You could spend it, keep it under your mattress, or deposit it in a bank account. However, there's a problem with the latter two options: inflation. Inflation is the gradual increase in prices over time, which reduces the purchasing power of your money. For example, if a cheeseburger cost $7 last year but now costs $10, your money is effectively worth less. Investing helps combat inflation by growing your wealth over time. When you invest, your money has the potential to grow, allowing you to maintain or even increase your purchasing power. There are two main ways your money grows when you invest. 1. Ownership in companies. When you invest in stocks, you own a small piece of a company. If the company performs well, say Apple opens more stores or sells more iPhones, the value of your investment increases as the company grows. 2. Compound interest. Often called the eighth wonder of the world, compound interest is the interest you earn on your interest. For example, if you invest $1,000 and earn an 8% return, your investment grows to $1,080 in the first year. In the second year, you earn 8% on $1,080, not just the original $1,000. Over time, this compounding effect can significantly grow your wealth. Let's break this down further with an example. Suppose you save $1,000 every month and invest it with an average annual return of 8%. After 7 years, you'll reach your first $100,000 milestone. The next $100,000 will take only about 4 years because you're earning returns on a larger amount of money. This is the power of compound interest. It accelerates your wealth growth over time. Part 2. What you should invest in. As a beginner, it's tempting to look at past top-performing stocks and invest in those. However, past performance doesn't guarantee future success. For example, Nokia was a leading phone brand in 2010, but lost nearly 70% of its value by 2020. Similarly, the biggest companies in the 1980s and early 2000s look very different from today's giants like Nvidia, Tesla, and Google. Instead of picking individual stocks, which can be risky, beginners should consider index funds. An index fund is a collection of stocks or bonds that tracks a specific market index, like the S&P 500, which includes the 500 largest U.S. companies. By investing in an index fund, you spread your money across many companies, reducing the risk of losing everything if one company performs poorly. For example, the Invesco Nasdaq 100 ETF, QQQM, tracks 100 of the largest non-financial companies listed on the Nasdaq. When you buy a share of QQQM, you're essentially investing in companies like Apple, Microsoft, and Amazon without having to buy each stock individually. This diversification reduces risk and makes index funds an excellent choice for beginners. Part 3. When and how much to invest. Before you start investing, there are two key questions to ask yourself. 1. Do you have high-interest debt, over 7%? If yes, prioritize paying off that debt first. Paying off a 25% interest credit card debt is like earning a guaranteed 25% return on your money. 2. Do you have an emergency fund? Aim to save 3-6 months' worth of living expenses before investing. This ensures you won't need to sell your investments during a financial emergency. Once you've checked these boxes, you can start investing. There's no minimum amount required. You can start with as little as $1. However, the more you invest, the more potential you have to grow your wealth. A good rule of thumb is to only invest money you won't need for several years, as the stock market can be volatile in the short term. Part 4. How to buy a stock. Let's walk through the process of buying your first stock. There are two main ways to invest. 1. Retirement accounts. These include 401k and Roth IRAs. They offer tax advantages but restrict withdrawals before age 59 and a half. 2. Brokerage accounts. These allow you to buy and sell stocks freely. Popular platforms include Fidelity, Schwab, and Moomoo. For this example, we'll use a brokerage account. Here's how to buy a stock. 1. Sign up for a brokerage account. Choose a platform that suits your needs. Moomoo, for example, offers free insights into what Wall Street investors are buying and selling. 2. Deposit money. Link your bank account and transfer funds to your brokerage account. 3. Search for a stock. Let's say you want to buy Apple stock, ticker symbol AAPL. Search for AAPL in the platform. 4. Place an order. You can choose between a market order, buy at the current price, or a limit order, buy at a specific price. For beginners, a market order is simpler. 5. Confirm the purchase. Once you've placed your order, you'll own a share of Apple stock. Part 5. Investing strategy and FAQs. How long should you invest? Investing is a long-term game. Historically, the stock market has trended upward over time, despite short-term fluctuations. For example, if you had invested in the S&P 500 ETF, SPY, in 2007, your investment would have dropped during the 2008 financial crisis but recovered and grown significantly by 2023. The key is to stay invested and avoid panic selling during market downturns. What are some good index funds? Here are 3 beginner-friendly index funds with low fees. 1. SPLG, Spider Portfolio. S&P 500 ETF tracks the S&P 500. Expense ratio, 0.02%. 2. VUG, Vanguard Growth ETF, focuses on high-growth companies. Expense ratio, 0.05%. 3. SCHD, Schwab U.S. Dividend Equity ETF, invests in dividend-paying companies. Expense ratio, 0.06%. These funds offer diversification and are ideal for beginners who want to build wealth without spending hours researching individual stocks. What about taxes? When you sell an investment, you'll pay taxes on any profits. Short-term investments, held less than a year, are taxed at a higher rate than long-term investments, held over a year. This is another reason to hold your investments for the long term. For example, if you buy a stock for $1,000 and sell it a year later for $1,500, you'll pay taxes on the $500 profit. If you hold the stock for more than a year, you'll likely pay a lower tax rate on that profit. Final thoughts. Investing is one of the best ways to grow your wealth and protect your money from inflation. By starting with index funds, avoiding high-interest debt, and staying invested for the long term, you can set yourself up for financial success. Remember, the key to investing is patience and consistency. Whether you're investing $10 or $10,000, the most important step is to start. If you enjoyed this video, make sure to subscribe to this channel for more content. Thank you.